Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now to the show at hand.
Matt Zalk here. I'm the host of the Same Day Podcast, where I connect with top business experts and real estate leaders. We previously had Brooke Reuter on talking about contract for deed versus lease to own options. And that was a great conversation that relates to financing and how you can finance homes or be the financier. Today's episode is brought to you by Keyrenter Property Management. At Keyrenter Property Management, we are a full-service property management company helping our clients buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of real estate and property management. That's why no matter what rental you have, single-family homes, condos, townhomes, apartments, we have the management solutions you need. Go to keyrenterpmc.com or email us at keyrenterinfo@keyrenterpmc.com. Today's guest is Josh Heintz, Vice President of Partnerships at LendingOne, a leading private lender specializing in real estate investment financing, backed by LendingOne's industry-leading SFR, that's single-family residential education. He partners with real estate professionals to maximize investment strategies and provide valuable insights on market trends. With deep expertise in strategic solutions and a passion for empowering investors, Josh connects investors with tailored financing solutions to help them meet their investment needs. You're going to hear all about that today. I also want to give a big shout out to NARPM, National Association of Residential Property Managers. It's a conference, it's an organization, it's a wonderful group of people, and that's how I got connected to Josh Heintz.
Hello,
Josh Heintz. Welcome to the show.
Hi, thanks, brother.
What's going on?
Man, just out here living the American dream or something.
I'm in Houston. I'm not in my normal recording studio with my microphone. I'm in Houston, but I asked you, I was like, sorry, I didn't block my calendar. Can you book another time? Then you booked another time, and I was like, damn it, I didn't block my calendar for. I'm doing our annual planning. We're here with another property management company doing some masterminding, doing our annual planning, and I was like, I just can't. I'm gonna do it. Let's go.
Hey, we can look, baby. We can reset. That's all good.
No problem. Let's go. Let's go. There's sometimes life gets in the way, and business gets in the way of life, and it's just we gotta keep going. How are you?
Man, I'm pretty well. Just got back, took a little weekend getaway trip up to Stowe, Vermont with the wife, and
Nice.
enjoyed that. A little authentic maple syrup, and so back down in Birmingham. So
Does it take like 1,000 gallons of stat to make?
it's a 50-to-1 ratio is what they told us. So about 2% winds up actually being, which is kind of crazy. But they got like the entire forest there is just tapped with these little plastic lines running out all these trees. It's crazy.
I would say our family goes through a quart of maple syrup a week, maybe every other week. I make pancakes and waffles for my kids basically every school day.
That's awesome. Okay, very cool. Yeah.
And we cannot eat pancakes outside if the restaurant we're eating at doesn't have real maple syrup. It doesn't have to be Vermont. It can be Maine or Canada, whatever. But if it's not real maple syrup, my family, it's crazy. I've raised these like elitist, these elitist maple syrup folks. I can't do that other stuff. It's too thick. It's too sweet. It's not the proper way to be.
There's nothing quite like some real authentic, like fresh off the tap maple. So I'll tell you what, it was fresh off the tap too. The only thing that you're going to see in Vermont is lumber, maple, anything, and then you got apples. So we got our fill of all those things for sure.
Got it. Good. Welcome back. How long did you stay out there?
We were there, got in late Thursday, and then we got back yesterday evening. So just about two and a half days.
Got it. I'm on the masterminding circuit here. I got my team in Houston. Before that, we were a bunch of Keyrenter franchisees meeting in Denver to talk business and best practice and a bunch of other stuff. So it's like it's clear. It's the end of the year.
Yeah. Oh yeah. Hitting it hard, getting ready for 2025. So what do you see being different in 2025?
That's a great question. Let me put my situation on do not disturb here while people are texting me. we've been noticing. So in 2023, rates started ticking up. People were shocked, and we found that a lot of our owners were selling. And that happened kind of across the franchise network. It happened in our portfolio for sure. And it's hard to determine whether people are selling because of one distinct thing like rates, or because across the board maintenance costs were skyrocketing. And of course, rent went up in a tremendous way. But if maintenance costs are in 1 or 2 or 3 months, or make ready costs are astronomical, people might feel the pinch and get nervous and sell. So we saw that. And now I'm wondering if the lagging effect of insurance cost spikes are going to again put our owners in a pinch where they go, you know what? I didn't make nearly as much money as I expected. The ROI on this is not as good as I thought, and I'm going to sell. And of course, in anything, whether it's the stock market or real estate, it's the compounding effect of time that really matters. So I'd like to communicate to our investors that you may feel a pinch because maintenance costs could go up and rent goes up here, and then maintenance cost keeps going up and rent comes across and is not, but it will eventually, like there will come a time when the return on investment stabilizes. All owners will have to raise their rents because the yield on their investment is curtailed or hurt at some level from rising costs in maintenance, in insurance, in property tax, etc. They will stabilize and the return will yield. The yield will return to a normal, stabilized kind of long-term average. You have to just be able to hold on for a small period. But I'm afraid that some people don't see. Some people will buy a property in 2020, in February of 2020, see a 15 or 20, 30% spike and sell. It's like, okay, you made 30%. So you on a $200,000 property, you made 60 grand. But what are you going to do with that 60 grand? If you hold on to that property for 30 years, it'll triple in value, and then you'll feel foolish. But part of the big thing is rates and refinancing and everything else. So let's talk LendingOne. Let's talk kind of what you guys are offering, what you're seeing in the market. I mean, what are your what do you think trend wise for 2025 as we enter this new year?
Yeah, I mean, the one thing that we talk a lot about is we're not in the business of predicting interest rates. If we were, we'd be in a lot better space for sure. The one thing that's hard to know is, we're sitting here November the 18th, not, even a full 2 weeks out from the election, and we don't really know what type of an impact long term that's going to have on the markets, what the Fed decides to do, what's going to be happening in the broader economy in 2025. So I think what was happening, in a lot of 2024, what people were saying was, survive till 25.
Let's wait.
And so now the thought had been, in 2025, things are really going to ramp up, and they may still, but I think what you're going to see is a lot of people are going to get into Q1 with that same mindset. Like, let's not hit the gas real hard. Let's ease into 2025. Let's kind of see what unfolds in Q1, first couple of months of the new administration. And then we'll have a better picture as to what we can project, Q2, 3, and 4 of 25 to look like. So look, at the end of the day,
it's still like they're still relying on their crystal ball in Q1 and Q2. And for all the people that called me in March of 2020 and said, I'm waiting for the market the bottom to fall out of this market so I can gobble up a bunch of real estate, and then came back in 2022 and they were like, I'm pulling my hair out. I can't wait any longer. I'm just going to buy something. And the prices are now 25% higher. It's like, just pull the trigger and go about your daily business. Buy real estate in good markets and bad markets. It's like a dollar cost average approach to the stock market. Just buy and buy and buy. And then in 20 years, you're going to go, I'm so happy I own all this real estate. That's my philosophy.
Yeah, no, I mean, nail on the head for sure. The issue is, for people who that it's their life, they professionally invest, they're always in it. You can't make money if you're not in the game, right? And right now, although rates are certainly higher than we'd like for them to be, they're not currently in a prohibitive place. If you're in a cash flowing market historically, then you can still find properties that are going to cash flow, right? And like we were talking about earlier, it's believing in and trusting in the fact that rents are going to continue to rise and they are eventually going to plane off, even if there is an increase in maintenance costs or insurance, that over time, the ROI is going to be there. And for the people that understand you can't play the game if you're not in the game, they're going to have to come off the sidelines at some point. And the one benefit that we're seeing to all of this noise and fear over the last 12 months is we've seen inventory starting to build back up. And it's starting to build back up in a lot of areas that are already going to be cash flowing spots in general. Look, in California, it's going to be really difficult to get that $2 million duplex to cash flow. It's just very difficult. But if you're in markets in Oklahoma and Kansas and places where you have that opportunity, rates being in the the sixes, in the fives, you're still going to have the opportunity to make money. And so people just have to get out of that 2020 mindset. Rates are, unless something really catastrophic happens that we don't want to happen, rates aren't coming back into the threes. And so people, once they get adjusted to that, they get adjusted to the new asset prices. I think that's when people are going to really start coming back into the game.
And so, I mean, to your point, it's time in market, not timing markets.
Yeah.
But it's, from my perspective, it's like, it may not cash flow for a year or two, and you may have to pay out of pocket and accept that your principal pay down of $150 or $200 a month on this investment is equivalent to your actually putting cash into the property of $200 per month. But in a few years, if you have a long-term outlook, and from thenceforward, you're going to be cash flowing. It's just accepting that. And now you have an asset that has appreciated from the time of acquisition. You have depreciation. You have, the negative cash flow is painful, but you have all the other benefits of ownership from this point forward. So I'm with you. We're still buying whenever we can find something that is marginal. We are like all in. And if you can exchange at this point, replicate the debt with a lower debt to equity ratio or debt to asset ratio, then you're just in much better shape. You've got to replicate the debt though to kind of make it work in most cases.
Well, and people have really got to change. People's appetite outgrew their eyes, right? And so people need to understand that, this expected, 10 to 12% price appreciation year over year, along with 20% rent gains. I mean, it can't continue. And it's like when people saw it normalize, because there wasn't any reversing. You're not seeing rents drop 10%. It flattened out a little bit. And it's like when people saw that, all of a sudden real estate became maybe less sexy than what it was. But the reality is we're now kind of back at the fundamental level for investors that say, hey, I'm not necessarily looking to buy one single family home and it's now going to pay all of my bills that I'm going to get through rental income. I'm buying this because it's a long-term investment that's going to help it is going to probably eventually, if it doesn't already, cash flow. But in the meantime, you are allowing somebody else to pay down that principal. You've got your price appreciation with it. Obviously, all the benefits come from, the debt and being able to, alleviate some of your tax burden. It's when people get back to those principles and they start seeing it through the lenses of most of, investment history outside of that 2 or 3 year gap, is when people are going to get a little bit more active.
So let's talk about why LendingOne specifically. How does LendingOne empower investors to make smart decisions about financing properties?
Yeah. So one of the things that's unique for LendingOne is that we are a lender specifically and exclusively for real estate investors. So we don't loan on owner-occupied property. So if you want a primary home, we're not. And it's not just that we don't want to do it. We can't do it. It's not what we're chartered to do, what we're set up to do. But we are set up to work specifically with real estate investors. That means that we cut down on a lot of the red tape that you're going to see through a typical commercial lender. And another thing that a lot of investors find as a frustration is actually a benefit with us. If you go to a typical commercial bank, they're not going to allow you to close in the name of your LLC that your property is through. They're going to ask you to close in your name, and then when that's paid off, you can transfer that title then over to your LLC. Well, with us, it's a little bit different. We only close in the name of an entity. So if it's a trust, a corporation, a LLC, what have you, then we only will close in the name of that entity. So the benefit for that for you as an investor, one, we're not going to be reporting on your personal credit for that loan. We don't care about your personal income. We're not, hounding you over W-2. One of the things that, Matt, you and I know probably better than most is the average investor is kind of poor on paper, right? And so, when they go to a bank and they say, hey, like, look at all of my assets, right? That bank's going to say, okay, well, your DTI is a little bit on the higher end. Well, for us, we don't care about that because our loans on our 30-year products are DSCR loans, which, if those listeners aren't familiar, stands for debt service coverage ratio. So really all we're looking for is for a property to cash flow. So we're underwriting the asset, where when you go to a bank, they're typically underwriting the individual, although we do care about the credit worthiness of the individual behind the corporation. We're primarily looking to see, does that asset perform? And if it does, that's typically what we're looking to make a loan on.
And so if it doesn't perform at 80% loan to value, just means that the investor will likely have to bring a little more cash to the deal, bring it to 70%, and then the DSCR ratios, the debt service coverage ratio, will be at 1.2 or 1.25 or whatever your expected ratio is.
100%. Yeah, that's spot on. So in a lot of situations, you're going to be able to find that property does cash flow. We do have a minimum 20% down. And so for those investors that are putting 20% down, a lot of times those properties are going to cash flow with no problem. But occasionally you're going to find one where you may need to come with 25, 30, or sometimes even maybe 35% down to make that coverage ratio right for us to be able to loan on. But typically 20, 25% is good enough.
A lot of our investors, and my partner in a bunch of real estate, Yoni, who you know, he likes to bring more cash to the deal. He wants it to cash flow from day one. He wants to force it. If not, he's like, I don't want it to be at 80 or 85% loan to value. I want this thing to be solidly ours. Feel like we have some cushion and some balance. He likes to be at 30, 35%. I don't necessarily agree with him, but we've taken that approach in the stuff that we bought together. What makes LendingOne? I'll start by saying, on the stuff that we're working on together, and you're working with some of our clients, you guys have very attractive rates vis-a-vis what we're seeing in the traditional commercial banking space. And it's not just rates, it's also terms, so we can get into the terms. But on the rates specifically, how is LendingOne able to provide such attractive rates when other commercial lenders are not in the same ballpark?
Yeah. So one of the things that's important to remember is, commercial lenders, commercial banks, they are in the business of loaning on owner-occupied properties. So you think about it, if you go to your mechanic and you say, hey, I know you've been working on my car, but I got a refrigerator that needs to be repaired, then it's probably going to cost a little bit more money, even if he can do it, right? Because he's like, hey, all of my systems and processes are built to work on cars, not on refrigerators. I'll do it, but it's going to cost way more than if you go to the Maytag repairman who's actually got his processes set up. We're very, very similar in that if you go to a commercial bank that is primarily there to loan on, auto loans and owner-occupied properties, they are going to occasionally provide DSCR loans for investor or loans for investment properties, but it's not what they're built to do. So their underwriting criteria, the specifications that they're looking for, the way that they want to go about evaluating not just the individual, but the property is at a much a greater scrutinization level than what you're going to get with us. Because again, all we're working on are investment properties for investors. So all of our processes, all of our SOPs and the way that we operate are going to be specifically for investment properties, specifically for investors. And so if you go to a bank and you say, hey, I'm looking to buy my, and you can only buy up to 10 where there's no cap with a lender like us. But if you go in and say, hey, I want to buy my 7th investment property, if you think about it through the mind of that banker, right, they've got to be thinking, okay, what is the likelihood that this is going to default? And so they're really, really worried about you as a person and all of the debt that you have. We work with investors constantly. Most of the people that we work with have, many, many properties that they already own as investment properties. And that's actually a plus for us. We've seen where you have been a successful investor for a long period of time. Fantastic. We want to loan to you that much more now. So it's mostly about how we've been set up and the fact that we specialize in that area where a typical commercial lender doesn't.
I'd also think that there's something around the cost of funds. Like a commercial banker, if I go to Bank of Oklahoma, MidFirst Bank, any other of my local lenders, they're sitting on some deposits and they can lend 10 times that deposit to keep the ratios in line.
Right.
To keep on the right side of the regulators. If they're buying their deposits, then they obviously have to charge more money. They need to make a spread to keep the administrative functions of the bank working, and also to make a profit for the equity shareholders of that bank. So it really depends, I would think, on the cost of the funds for that commercial bank, which in a local community means you either have grandma that sits on a lot of money in her checking and savings account, or businesses that maybe run a little bit leaner and don't keep as much money in there. And the bank has to then go and pay more interest for those deposits to actually come in so they can lend. Yeah. You guys, I mean, you don't operate like a traditional bank, I would guess. I don't really know. We haven't talked about that, but you have a source of capital that you can lend against. Is it not subject to the same regulations as a traditional bank would have?
No, so we're governed a little bit differently than a typical chartered financial institution. We still have plenty of, laws and regulations that we have to keep up with. I mean, given that we're loaning money, but we're not loaning on Fannie Mae and Freddie Mac. So this is all what we call, so LendingOne is what we call a private lender. Private being that it's our money. So we're not going and we're getting money that's backed by the government. We're going
That's
out,
the big difference.
And we're pulling down money from, warehouse lines from large, financial institutions, to where we're not, like you were saying, if you've got grandma that's now going to make a certain interest rate, and then they've got to build off of the back of that.
Grandma's money's not at risk.
Right. In our situation. So being a private lender, it's our money that we're lending out. And so that's how we can also help keep rates, well below what you see at banks.
Yeah. So it's ultimately it is the expected return on your capital that you're optimizing for, not administrative costs of the bank plus the profit, et cetera.
Right.
Let's talk for a second about terms of some of your most attractive investor products.
Yeah.
A traditional bank, so that the Fannie Mae, Freddie Mac banks would do 30-year straight line conventional loans. A commercial bank, like, as I said before, MidFirst or BOK, would do a 5-year term with a 20-year amortization. And after 5 years, you've got to decide, are you going to refinance, or are you going to pay this whole thing back? Like, what do we want to do? What's the investor-friendly LendingOne product?
Yeah, so there's a number of different options. So although we are exclusively a lender for investment professionals, we're not a one-trick pony. So we have a lot of different products depending on your specific situation. The one thing that I will point out that is of importance is we're a single family lender. So we will loan on single family rentals. What we consider single family, because I know the definition varies a little bit, is anything in the 1 to 4 space. So a townhouse, a condo, a duplex, a triplex, a quadplex, all good, all things that we'll loan on. What we don't currently loan on is what you'll see a lot of, like mid-sized multifamily. So 12-unit apartment complexes, that sort of thing. So just to get that out of the way. So on the single family side, and we also do short-term rentals, those look a little bit different, but on the long-term rentals, we have, if you're a flipper, we do have a fix and flip product. So if you just want to come and you want 12 to 24 months of, interest-only financing on a flip, we can take care of you. If you're somebody who's looking to pick up a single family asset with a traditional fixed, we do offer a 5 and 10-year ARM. It's not really popular, especially right now with an inverted yield curve and a couple other things. It doesn't make sense for people to be in that space. But typically what we do are 30-year fixed. And
the inverted yield curve is indicative of the notion that people expect rates to come down. I don't know that. I don't know, I'm not savvy enough to understand all that. But from what you say, I take it nobody wants to fix for 5 and 10 years with the inverted yield curve. Makes me think that yield curve indicates that it should come down.
Yeah. So, the factors that affect the interest rate, there's credit risk, there's interest rate risk, all those different things. And people typically would say, if I'm going to hold this, if I'm going to, write this note for, 10 years, it should be more expensive because I'm having to carry the risk for a longer period of time than for 1 year. But right now, if interest rates are high, but they're expected to come down a little bit more in the future, then all of a sudden, The shorter money is as expensive or cheaper than long-term money, where typically you would say, hey, I only need it for a year. So that interest rate risk or that time period risk is a little bit greater. So those are the differing factors. But that's why people aren't really interested in the 5 and 10-year ARM, because typically 5 and 10-year ARMs, you would say, hey, that 5 years guaranteed, and then it's going to be whatever. It's going to be some type of prime and then plus a little bit of money. And people will say, okay, well, I can get it cheaper for the 5 years versus something guaranteed for 30 years. But now, because interest rates on the short term are so high, you're not seeing that value. So most people are going with a traditional 30-year amortized over 30 years. And we do have 2 different products within that. So the first one is a very traditional, just like you would see on an owner-occupied loan. It's 30-year fixed rate, amortized over 30 years. We also have
which is not a product that a commercial bank will offer. They don't have that they will not execute the swaps and hedges required to guarantee that money for 30 years, just so people know.
Yeah. And then the other is we have it's another 30-year fixed rate, but the difference with this one is it's a 10-year interest only period that then amortizes over the final 20 years. So if you want something, so we're talking about cash flow earlier, and cash flow is a little bit, difficult in some markets or for some people right now. And for people that are primarily interested in cash flow, because there are a lot of investors, although, it's always a great idea to buy and hold for life, right? There are a lot of investors who say, you know what I do is I get in, I want to find a property that cash flows, I keep it for 5 to 7 years, I take advantage of the price appreciation, and then I'll sell at some point in 5 to 7 years. This is a great product for somebody that has that type of mindset, because it allows you to cash flow at a higher level. Obviously, you're not able to take advantage of any principal pay down over that 10-year period of time, but cash flow can be significantly greater over those first 10 years. You still take advantage of the price appreciation. And then if you want to hold on to it, it's still a fixed interest rate, even as it amortizes over the final 20 years. What we know is most people in that 5 to 7 year range are probably going to refi out into another long-term product before that comes.
Interesting. Those are 2 unique products for, I would say, serial real estate investors. The average person with a W-2 can take advantage of a 30-year conventional mortgage that Fannie or Freddie put together, but they only have 10 after that. And again, I go back to being a serial investor. So somebody that's doing it many, many times, they don't have that opportunity anymore. And they do have that opportunity with LendingOne. Yeah. And then number 2, for those people that want to take advantage of the cash flow early on, there's not besides a construction financing kind of bridge period, I don't know of any commercial product other than this at LendingOne that will allow you to only pay interest for a number of years. And even when you do that bridge program, it's generally 24 or 36 for like a heavy renovation of an apartment complex or maybe even a single family house, but you wouldn't expect you'd need 36 months to renovate a single family house.
Right. And so that's another thing that makes us, pretty unique, is we don't have to go and jump through a bunch of hoops. I mean, it's our money. And so we can dictate the terms in the way that we loan it out. And so we were able to go and create a unique investment product like that for investors. Because look, no investor, investors aren't homogenous. Investment properties aren't homogenous. I mean, everybody's unique. And so we have very tailored solutions depending on what your particular needs are. So we do traditional purchases. We also do, cash out refinances. We do portfolio lending. So one of the things that is pretty unique for us is if you wanted to, if you found, 5 to 7 homes, let's say, so I'm located in Birmingham. So let's say you find a home in Birmingham, or found one in Tulsa or Wichita or Kansas City, wherever it is, and you find 7, somebody selling a portfolio of 7 homes. Instead of having to go and underwrite 7 different homes and pay origination fees on 7 different homes and then pay closing costs and so on and so forth on 7 different homes, we have a portfolio loan where it's one application, it's one origination fee, it's one loan, and it's one payment on all of those properties. And so being able to do that in a bucket together is of a lot of value. And so one of the things that's actually pretty cool about our portfolio product is, let's say that you find, in that 5 of those cash flow really well and 2 of them don't. Well, the way we underwrite a portfolio is on the total DSCR ratio, not individually any property. So let's say you find a property that you know will start cash flowing at some point in the future. We're not really worried about that one so long as the portfolio ratio is equal to, being able to cover its debts and liabilities. And so that can be an advantage for investors that are looking to pick up, groups of properties at a time.
How does it work on the partial release of the lien if you want to sell off one or two? Is that a complicated process? Is that an easy process? And what happens to the remainder of the loan? Does it recast? Is there an automatic thing, or is it like you still owe the same amount in principal and interest each month, even though you have less asset now in the portfolio?
Yeah, there is a recast, but I'd have to get somebody else to answer that question. I wouldn't want to provide something straightforward and honest.
Yeah. So that's one thing that we see when we have bundles of properties and you want to sell one. Sometimes you want to sell one to create a comp, and then you want to refinance for the whole portfolio. Now you have a really good comp to get the appraisal done against, or you just want out of one asset. And there's a consideration there that you got to figure out what the partial lien release looks like. So for investors out there that are thinking about that, that's something to consider. Let me ask you this. On a cash purchase, cash refinance, if an investor wants to come in and take out their cash, is there a seasoning period? Does it need to be owned for some certain amount of time, in other words, or can they go?
Are they renovating that? Or are they renovating that, or do they just want to buy it so they can quickly get into the deal?
Let's say I buy a property, $100,000 cash. I put in $30,000 of cash to do the refinance. Sorry, to do the renovation, and now I want to do a refinance.
So 3 months is the seasoning on that.
3 months. Okay. Yeah. So if you're going to do a full renovation on a house, you want to be in it 3 months prior to. You got to own it from closing date to refinance. What application or closing? It's got to be 3 months of ownership.
Right. Now, it also depends as well on if you're doing a cash out refinance or if you're just doing a rate and term finance. So some of that depends, but generally speaking, in that situation, we would not have to wait until day 90. We would begin that process at about day 45 so that we would actually close on the 90th day.
Got it. Understood.
And then, so another product that we have that is kind of in alignment with somebody who is looking to invest with that type of strategy is we have something called a fixed to rent product. So what it is we start with a short-term bridge loan. So what we do is we will provide up to 90% of the purchase price to buy a flip. We'll provide 100% of the rehab cost. So let's say that you go and you find that property and it's $100,000, you got to put $30,000 in it. Then we'll loan you $90,000 on the purchase. We'll give you all 30 of the rehab cost. And then we will turn around, and if you're wanting to hold that property, then we will refinance that into one of our long 30-year products. And so what we do is during the interest-only period of that fix and flip, then we'll give you a discount on the interest rate, and then we'll give you a 50% discount on the origination fee when you turn that into a long-term loan with us. So you basically get a buy one, get one half off for the loans, but it gives you two products with one. So it's basically BRRRR in one product.
Got it. I love that. And you get the discount when you do this, when you do the refinance to the long-term product.
Correct.
It's you're not locked in. In other words, if you feel like this is a great deal for a long-term, for a BRRRR, and then you do the project and somebody makes you an offer for 3 times what you have in it, you're not locked in. You go, shoot, let's sell this thing and do it again.
Absolutely.
I love that. What is your best client type? Is it a new investor? Is it a seasoned investor? I know with seasoned investors, there's lower risk. You have a track record, but in an ideal world, who do you like to work with most?
So, and we love to work with everybody. I'll tell you who we probably work with the most, is somebody who has a handful of flips under their belts or 1 or 2 investment properties that's looking to build their portfolio. And they're starting to realize that they can scale faster with a private lender like us than they can with their commercial bank. So somebody who may have one or two properties that they already own and they're looking to continue to build and grow. Because one of the things that we like to be, we're not just a loan processor. So when you call us, we're not just going to say, hey, yeah, thumbs up or thumbs down, like you would get at a commercial bank. You're either approved or you're not.
Yeah.
The loan advisor you're going to be talking to is going to work with you, soup to nuts on whatever deal you're looking at. But they're also going to help you look at your total portfolio and think a little bit outside of the box. Hey, have you thought about, two properties here, you built this equity. Have you thought about doing a cash out refi? Then we can take the two you're looking at and the two you have and put them in a portfolio together. Because on those portfolios, sometimes we can get a little bit more aggressive with the interest rate. So we can make that a little bit cheaper. So when you talk to somebody on our team, you're getting more than just yeah, you're good enough, or yeah, the property is good enough. We're going to really work you through what that looks like. And then, most of the people on our team have been here for a long time. You got a chance to meet Hunter, who's been here for many, many years.
He's great.
And so,
God, he knows y'all's product really well.
Inside and out, right? And so now, you or Yoni, it's not a matter of having to pick up and you got to call an 800 number. You got to hope you can talk to somebody. You can text Hunter and say, hey, here's an address. I'm looking at this deal. Send me a quote. And then, 15, 20 minutes later, you get something in your inbox. Yeah. That is really kind of a competitive advantage when you look at us versus a bank. That is one of the huge competitive advantages that we have, is just that we have people boots on the ground and we control that process soup to nuts. So we've got everything in house from, credit risk, underwriting, valuations, legal is all on our team. And so Hunter can walk down, the hallway there at the corporate office and talk to whoever it is so we can get answers quickly. You're not having to wonder where your loan is in the process. We can give that information out and we keep you apprised the entire way through.
So if somebody's thinking right now, I've got a perfect project that I want to finance, a house, an investment property, who do they reach out to? How do they find out more information?
Yeah, so they can reach out directly to me, and I'll make sure that I've got them in front of the right person. They can reach me one of two ways. They can either give me a call. My direct line is area code 561-486-7911, or they can reach me at by emailing me at Heintz. Last name is Heintz. It's kind of like the ketchup, just with a T in there. I don't have quite that Heinz money, but it's Heintz at LendingOne.com. LendingOne is all one word. So they can reach out. They can reach me through either one of those mediums. I'll listen to a little bit about what they got going on, and I'll make sure that I get them in touch with the right person on our team to make sure we can help them best.
Beautiful. Josh Heintz is the Vice President of Partnerships at LendingOne, a leading private lender specializing in real estate investment financing. Backed by LendingOne's industry-leading SFR education, he partners with real estate professionals to maximize investment strategies and provide valuable insights on market trends. With deep expertise in strategic solutions and a passion for empowering investors, Josh connects investors with tailored financing solutions to help them meet their investment objectives. And I will say one thing, Josh and I connected before the recent NARPM conference in Dallas, which is NARPM is always a great place, but it's an indication that Josh is really on the cutting edge of what's going on with real estate investment, with property management. We didn't even touch on property management, whether that's something you guys look at as being positive or negative. But Josh, I appreciate you being an active participant in the industry and everything you've done for our clients at Keyrenter.
Yeah, absolutely. Well, it's been a pleasure. I've loved getting to know you and Yoni a little bit more, and hopefully we're building something that'll last for a long time, and be happy to help you, your clients, anybody that's listening in any way that we can. And hopefully we'll only continue to get better. And hopefully these rates will maybe start moving in a little bit more favorable direction, which I think we all believe that they probably will. And now it's just a wait and see.
From your lips to God's ears. Josh, thanks for being on the show. Appreciate it.
Thanks, Matt.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.